Okay, so moving on, let's move on to the strategy. Given the perspective on the global and local environment, we've asked our customers in COL Premium about your expectations of the PSEI by the end of 2018. And well, it's a lot, not a lot, but a bit less bullish than when we started this year. Around 46% are saying that we're going to be neutral, that the market is going to stay within 6,900 to 7,500, while 36% are still weak bulls, expecting the market to end between 7,500 and 8,300. So April, let's ask you again, what do you think are the catalysts that could possibly materialize these levels, meaning the weak or possibly a strong bull,
Yeah.
if possible?
So I guess I'll start out by saying that our target is 8.6. So you might say I'm a strong bull, right?
8.6. Okay.
But that said, what are the catalysts that will allow it to reach 8,600? Because 8.6 is fair value. We've identified four major catalysts which we think will allow the market eventually to reach that. And these have to materialize, in our opinion. Inflation finally peaks. Corporate earnings growth beats estimates. The US Fed stops raising rates. And US-China corporate earnings or global corporate earnings will remain strong even with the trade war. As, as proof that we shouldn't really be worried about the trade war. But the bad news is, of course, inflation, which we thought would peak in June, actually disappointed, and it continues to go up. As you can see, the factors which are pushing up inflation, aside from the tax reform program, would be crude oil price. It's still going up. Rice prices, diba? That's why, initially I was wondering, why do they even talk about rice in the news, And upon research, I found out that the rice price in the Philippines is double that of other countries because the government is controlling the importations. That's why lately they talk about rice tariffication, diba? Because what they plan to do is they will allow importation of rice that is half the price, and then they will impose a 25% tariff, and the tariff that they will get, they will use to subsidize the farmers instead of what they're doing right now, which is supporting prices at a very high price. So sabi nila, may import na daw, pero mataas pa rin ang price. This is a weekly data we get from the PSA, by the way.
Right.
And of course, we have the weak peso. And you go to the next slide. So the weak peso is not good for us because we import a lot of things. So that's inflationary. And finally, I just want to point out that, kasi I think if you remember a month or two ago, the DOF, Central Bank, were talking about, oh, we've seen the worst, inflation has peaked. But I think biglang 180-degree turn yan eh. The reason why they changed their mind is if you look at the month-on-month inflation, you'll see that after jumping up to 0.9 and then falling to 0% for the month of May, it picked up again to 0.6% in June. Ibig sabihin lang, yung mga tao na nag-delay ng price increase when June came around, they actually implemented the price increases. And it shows that the economy is strong enough to absorb such price increases. That's why businessmen actually took the opportunity to pass on higher costs to the consumer. So, kaya biglang nagpalit na sila ng tack, and they're saying we're gonna be more aggressive in addressing inflation. So that's a problem. Inflation is taking longer than expected to peak. So it's gonna be a problem still. And then this one, well, this is the dot plots that I was talking to you about. Every time the Fed has a meeting, the 15 members will be asked, what do you think interest rates will be in 2018, 2019, 2020. So, makikita nyo, so they're still expecting interest rates to go up 2 more times in 2018 or another 50 basis points, bringing the total increase for this year to 100 basis points. Come 2019, but it's not gonna end this year. Next year, they're gonna increase it 3 more times.
3 more times.
So, ibig sabihin, the ending of the Fed rate hike cycle is not expected to be this year, mga towards the later half of next year. So that's another catalyst that, it might take long to materialize. And finally, the last two ones, corporate earnings growth, beating estimates. Unfortunately, for the Philippines, I don't think it's going to happen. For the second quarter earnings season, which is happening right now, several companies have already come out with earnings, and so far they have all been disappointing because of higher costs, being hurt by inflation. It was a problem in the second quarter, and it's showing. Pag walang earnings growth, wala, diba? And I think even for US and global companies, people want proof that the trade war isn't going to be a problem, and I think they'll look at the third quarter and fourth quarter earnings before they safely conclude that yes, it's not a problem. So we won't see that until end of the year. So again, I mean, these are the catalysts, and it will take long for them to materialize. That's our concern. Yes, our target is 8.6, but the catalyst for the market to go there might take a while to materialize. Okay, so baka sabihin nyo kasi sobrang bearish.
Oo nga, tatakot na ako.
But that said, that's why I want to say what the good news is. I agree with Juanes that we've seen the bottom at 6.9. Based on historical corrections, the average drop of the market is 17%, and we've actually seen that already. At a 17% drop, the market should be trading at 7,495. Okay, so we actually fell below that, and in terms of duration, 3 months. We've been in this correction for more than 3 months, so the magnitude and duration is already there. Okay, and in terms of valuations, okay, just to make it easier for everybody, rather than talk about each and every stock, you'll see that among the index constituents, when the blue bar is below the zero line, it just means that it's trading at a valuation which is below its 10-year historical average. And you can see that most of the stocks are currently trading below their 10-year historical averages, except for a handful of stocks like SM Prime, SM Meralco, URC, and SEC BBDO, no? But most of them are parang bear market valuations na, murang-mura na talaga sila. Showing that negatives are priced in. And this is another evidence that negatives are priced in. In January, we talked about, or I highlighted the fact that I was concerned about the forecast on inflation. Because in January, they said the economists were anticipating an inflation of 3.6% in the Philippines, which in my opinion was a very low forecast. But as of today, you can see that the inflation forecast has been increased to 4.5%. 10-year bond rate, initially they're saying it's only 5.3. Now they're saying we'll probably end the year at 6.2. EPS forecast for companies, naging conservative na rin, nag-cut na by 4.6%. And well, for us, PSEI target is now down to 8.6. And in terms of what is being reflected in the market, the PSEI is down 16.5%. In other words, nag-derate na tayo. No? From 20 times PE, we're now at 17.5 times PE. And our 10-year bond rate has gone up already a lot. In fact, it's really 6.7, not 6.6, from 5% earlier this year. So a big adjustment really for interest rates and prices, such that it's a lot more attractive. And my feeling is the negatives are priced in. No?
Okay, so...
And finally pala, okay, one of the factors that people said were important was economic growth. You shouldn't be worried about it. We don't have any problems as far as economic growth is concerned. The first quarter, you saw GDP increasing by 6.8%. Eh di ba nga kagabi si Trump pinagmamalaki yung 4% ng US. O tayo 6.8, di ba? So that's, that's nothing. 4% is nothing, di ba, for the Philippines. And one of the factors which drove economic growth strongly was government spending. So tax reform program isn't bad. it seems bad because of inflation, but this is what allowed the government to increase their spending by 13.6% in the first quarter, which is the reason why we had a 6.8% growth. And second quarter, it's still going to be strong because if you look at the headlines, it's saying the government increased the disbursements by 14.9%. And then going forward, we go to the next slide. The budget for next year has already been disclosed, and we're seeing a 13% increase in the budget for next year. And the DPWH budget for infrastructure is up 68.3%. And well, usually for upper class people, you don't like a weak peso because you can't travel, imported products are expensive, but it's actually, a weak peso is actually good for OFW remittances. Consumers end up spending more, okay? And people who earn minimum wage, for example, and 25,000 and below actually had an increase in their disposable income because of the tax reform. So those are the reasons why we're still positive.
To me, oil is the #1 commodity that generates movement into that inflation rate. So oil prices have been actually on an up move that's been quite aggressive. There were certain issues that were coming up. Some have to do with geopolitical concerns that kept oil on that run. I don't see any immediate change in the trend. We still have an upward bias into oil prices, but we're a little bit on the lower end of the channel that it's currently at. It might be able to even go sideways or a little bit down to hit the lower end of that, which is, I think, closer to about $67 per barrel. But the general soup is still upward, and until we break below that 67, the potential for oil to remain into that particular move is quite strong, and it might even go all the way up to $75. So I think there's still that increasing threat. In terms of, we can go to the next. In terms of metals, if you notice what's being out, it's actually against the inflationary impact because precious metals and base metals have actually gone down. And the reason that's going down is because you've had a strong dollar. And as the dollar continues to keep its strength inside, and we've been getting battered on these particular price sides, that's why you've noticed some local stocks that are on the mining side have not really been responsive. Some are still moving on speculation, but primarily those that are based on the earnings is still quite weak. I think Felix reported earnings that was also quite weak. And by the looks of what you're seeing there, since you're seeing those lower prices moving lower, the impact on those companies will more likely still be sustained. But I don't think that'll be adding to too much on the inflationary threat. Now, with regards to the Philippine peso, unfortunately, I still see weakness. We might be able to get some sideways movement for the meantime, but the trend here is still on that weakening stand. The peso-dollar rate, as you can see in the chart, is still on an upward trend. And we're going to be coming closer to that trend line soon, and that means it's going to put pressure on the peso to see whether it's going to stand there or whether it's going to start to devalue once again. So at the low side of the peso, I'm thinking support between maybe 53 at a maximum, maybe 52.62. On the upside of that, maybe up to 54.50, maybe looking for 2 months. The possibility of 55 is still there. I know I've been hearing that a lot from the market now. And I still don't see any major impact. Maybe just a bit more slower rather than too much of an aggressive stand. And whatever more sideways rather than an upward move you see in that particular rate would clearly be welcome, because I'm in favor of the stability rather than too much weakness coming into that particular rate. But trend remains the same.
Going back to our survey question kanina, we've asked them about their views on the market. Anong tingin mo, Sir Juanes? What are we looking at here? From this potential first sign of recovery, can this potentially bring us all the way back to the 9,000 level?
I do not think so. Again, there were a lot of things that we had to factor in that were not present at the time. The speedier upward in rates, like we talked about, the inflationary threat, the not so exciting corporate earnings growth you were looking at, as she said. What you're seeing is a market that got soused down, was very oversold, generated a rebound, and that market, after it tries to normalize its price, is going to have to determine, okay, are things normal again? Can growth take me back up to a higher level? And if it's unexciting, then your market will coast after it hits that normalized level. And so I'm thinking that's what this rally that you're seeing is going to generate, that condition. But again, I would agree with April when because she made a stand, she's saying that I think we've seen the market low, and that being the 6.9 low. And I more likely agree with that particular case. And there are a few evidences of why that's so, right? Okay, so we have first, if you look at the Philippine Stock Exchange Index, we'll deal with the Elliott wave. I did present this on the first half, and I was talking about, I was a little concerned because we were going up in an intermediate trend into a fifth wave, and I was anticipating that we're going to have a corrective wave. But if you can see there, the chart on the right side shows almost, a vertical drop. And this is unusual. Normally at this phase, if you don't see a counter rally, that's telling you that the trend here is very weak. And so the rally you see there was a very small sideways motion, as you see here in the lower right side. And it felt like a market that could not even breathe back up after being oversold. And that's, to me, is a concern. But if you look at the chart on the left side, it did bounce off the blue line, which is the uptrend line that we've had since 2011-12. And so far, it hasn't broken that. And that's very material for us because at least the market still respects that major support. And it feels as of this time that it was an untoward decline and requires that particular rebound for now. Now, another reason, I know April showed you the state of corrections throughout. I put this in a little bit more proper perspective. So in terms of looking at the pullbacks we've seen the market have done, so let's say if you're looking at the ones that we've started roughly after 2010, the reactions that came in after that time, you have about 3 or 4 of them now, and each one of those particular declines, on average, would pull back maybe by about 23.4%, right? Just to put a little note on that value, 23.4%, which means it crosses what we call the bearish territory, which is a drop of 20% from the high of a market. Now, that's why, whenever that normally happens, at least so far in the last few years, and people come running up to me and say, oh my God, Juan, is bear na ba to? Bear market na. And I said, the mere fact you're telling me that, or you're pointing it out to me, puts a smile on my face because every time it happens, the market rebounds. And that's why in the study of technical analysis, there are 2 qualifications that tell you whether you enter a bear market. The first is, yes, the market must go below 20% from its high. But there's a second qualification that not too people talk about. The market must stay down there by more than 2 months. And the reason is because you might just get a flash sell-off because of emotion, because of worry, because of whatever external event. But if it doesn't stay down below that 20% for that duration, and it recovers right away, then it's just, it's an oversold condition, perhaps driven by mania or emotion, and the recovery of the market shows you that it's not sustainable. Okay, so I want to cast that fear out for now, all right? Although I was wondering when you said earlier, it looks like the ingredients are going back, so we'll watch that very carefully. Another thing that you'll also see in there, if I may borrow the PE band again, right? The PE band shows an average PE low of low side PE about 15.9 times. I think these are forward numbers. Right? And the numbers is showing you roughly at about this level, the market also shows major lows. So corrections up to about 23% usually establish lows. PE bands of about these lows usually establish lows. Another thing that also we talked about in the beginning also of the year was that I anticipated roughly a 5 to 7 month correction time because that's roughly the average period corrections normally last so far as registered. And so if the average correction time was about 6.5 months, we're coming kind of close to that period already since we began. So there's another factor that says enough is enough. And this is the reason why I think the market is trying to breathe itself back into life. Of course, the argument against me is at the time we were having all those corrections in the past, we did not have inflation running, we did not have interest rates running, and these are the concerning matters that might change the picture. Now, I guess time will tell whether in the next 6 months or 8 months whether such threats will continue, and if inflation does taper off as the government is suggesting, who knows, maybe we'll be able to see a bit more of that rally come into place. Another issue, just to also point out, just want to make sure you guys are aware of this. August is our favorite month of the year because it is the worst performing month in the stock market for the year. And if you can see the graph you're seeing there, the seasonality chart, you can see the lowest performing. Not only that, it also produces a negative. And it normally comes right after the previous month, which is one of the strongest months of the year. Have we just had a strong July?
Yes.
So we did about 6.5% as of Thursday, which actually outperforms what you're seeing there, which is standard about 3% for July normally. So after coming from a very, very strong month, and it says there, does it look like you have the capacity to come down again in the ghost months? Well, you can play with that thought. But as far as I'm concerned, the statistics shows that there's a possibility, especially after coming from a strong month. We just had a 6.5% recovery. There is some downside here. So I think the way I would look at an opportunity here is, okay, if you prepare yourself, if we may have a weak August or possibly even a weak November, you might want to be, gradually looking for opportunities coming towards the end of these months, right? Because the market jumping up the way it did, to me, is the first testament of strength. But coming from a very weak condition, you're not going to have the market lighting up immediately. It takes some time. So you might ask, so when would be a proper time to enter? You wait for those months to finish. That might give you a better possibility in terms of the timing essence. All right. This is the way I expect the market to show itself to you. Right? I will run two scenarios. Let's start with the first. So if you see the downward channel that you have there on the left side of your chart, and we see prices breaking over that trend line now. We've just done that. So roughly in that particular area, that's the first area that's going to trigger the potential recovery, right? So this is usually the first rally. The first rally normally is the biggest because it catches people unprepared. A lot of people have not put their positions back in yet. So when they see prices going up, some people say, I've seen that going up, it normally goes down, and this time it didn't go down. And now, as it is elevated, you're saying, so what do I do? Am I going to miss the boat? So 9 out of 10 people who normally convince themselves to buy in this rally, buy it near the high. Only because you're waiting for too much evidence to do that. And of course, trend line is helpful in all that. Unfortunately, after that, you're going to get a sideways consolidation coming. It could come in two forms. It could go, if the market is strong, it will just go sideways, right? Just like what happened in the last correction. It jumped up, went sideways, broke out, and went straight up. Or, and I think this is probably going to be a case, is in the first case, you'll see prices start to go down again like a downward channel or a wedge or a triangular pattern like you see there. What I don't like to happen is a retest of the previous low, because it might be a little scary, because as it retests that low, there's a small possibility it might even break it for a while, get everybody spooked up again, everybody cast their positions out only to find out the recovery back in place. That's okay. That's what we call a double bottom. That's how they normally craft themselves. So I'm thinking these are the two scenarios you just have to be prepared for. So just be careful this rally you're seeing immediately, because I don't think this rally is it yet, right? But it is testament that it looks like the worst is over for now, and the market just needs to base build. And that base building process takes a little bit of time. It needs to convince more people like us that the markets are good in valuation, that to gradually buy it, because there are still some headwinds existing. That's not over, and it needs time to generate ourselves out of that condition to create more forceful impact into the ability of that. So finally, just to show you an example, so the picture there on the left is an example. That's a real issue. So the first one is Banco de Oro, and I showed you a picture back in 2015, 2016. So here's an example. So you see the downtrend there on the left side, shooting up, going above the trend line, and working up this correction that comes in later. And mind you, that took a few months to build. All right, so you may have to anticipate this. So if some of you guys are working into this rally, I would prepare you for another pullback. Okay, so just ingat lang. You might be able to get that in good time. So again, normally the first big rally, that's just your tip-off, things are changing. Then reaction consolidation to try to retest support and engage new accumulation, and eventually the market will turn. And the second example is a double bottom, and you have pretty much the same conditions coming out there. This happened in Ayala Land. So I would really prefer the first one, although you might not like it. But to me, I give very clear evidence that market turnaround conditions are taking place. Later, when we talk about some individual stocks, I'll show you examples like that.
I have a quick question. One is because I'm the one of the few, I think, a few people who actually bought during that huge rally. And talking about this second chart that you've shown here, there's a possibility that it will retest and break the previous low. So how do you know if that low is going to tutuloy ba, or is it gonna finally do that?
It's not the job. Whether kung tumuloy siya, then you take your longer vacation.
Okay.
But what we're hoping for is, like we said earlier, there are good evidence that those lows will likely hold.
Okay.
Right, and that the context of which that you're asking is, when do I enter again? If you're into a rally right now, my advice is start taking some off the table.
Okay.
And that means you take some profits first just to secure what you've made into the short term. If the market does go down, that gives you the ability to have some cash available for this next reaction.
Right.
If you keep yourself completely in, and that thing starts to turn down a little bit, in the beginning you might say, oh, kaya ko to, now I can survive that next reaction. Anyway, I know it's eventually going to go up. Let that go for 1 or 2 months, and let's see if you say the same thing. Because I'm sure as that market starts to turn down, you're going to be convincing yourself otherwise. First it's, oh, kaya ko to. Next is, kakayanin ko ba to? And next, hindi ko na kaya. Right? And you're the one selling when that thing breaks the previous low, and that's when the next low comes. I know it doesn't sound good, but it's best to be prepared for it so we don't get involved in it. But that's how we learn. And that's the context of it. So you're learning, Ed.
Thanks for that.